All right.
All right. We are live day 3 of the Purse Strings Takeover on the 50 Plus and Fabulous group.
Yes. It's been go ahead.
Today we have Bo. So we're going to talk about Social Security.
So this is taking over the world?
Yep.
Of course we are.
I showed up at the right place. I like it.
Yeah. Taking over the world. That's right. You know, I always say, they used to say the future is female, and I say the future is now. So, yeah, women are a very powerful market, and that's why Purse Strings is here to help arm women with the right tools and resources to make great financial decisions. And Bo, in this group, the 50 Plus and Fabulous group, Social Security was one of the top, if not the top 3 on their list of a topic they wanted to learn about. And we hear a lot about it, I think, but no one really pays much attention until they hit that sweet spot where they need to start thinking about it.
And it becomes real.
It becomes real, yeah. And although for some people they think it might be confusing, I know that you will make sure it's not. You'll answer all their questions and get them set up.
You know, one of the things, I'll get into some specifics here, but this amazes people. There's over 500 ways to claim your Social Security strategy.
What?
And most people don't put a lot of thought into it. It's just, I think I'll do it at 62 or 64. And the reality is, if I'm sitting down with 10 households, it's 10 different strategies. Everybody has different variables, goals, a lot of things. And it's no wonder, well, I'll get to this stat in a minute. 96% of people get it wrong. I'll tell you that. So,
wow. Yeah. Well, sometimes flexibility can be too confusing.
Right.
You know, it's too many options. And that's why we have experts like yourself and others who are going to help women figure out the best way for themselves. Because as we know, women will age alone for the most part. Mm-hmm. And this income is really important for them.
And why I was excited about doing this, guys, is I've seen the Social Security decision impact women a lot because of that, because they tend to age longer, age alone. And sometimes they're the one left holding the results of a decision maybe made a while back. So I think it's very important that we talk through this.
Absolutely. Like I always say, I mention this a lot, you know, it's kind of like I reached my breaking point when I was in Target with Maggie several years ago. And this woman who was of retirement age was bagging groceries. Mm-hmm. And, you know, we've seen that a lot. And women who should be enjoying their retirement. And there was a big article on it in the Atlantic. They have to cobble jobs together often because those decisions, financial decisions, were not always made on their best behalf. And oftentimes they're not at the table taking part in the conversation and really understanding the impacts of financial decisions being made. So again, another reason why Maggie and I really determined that women need knowledge and skill and the right resources like you, Bo, our Purse Strings approved providers who are going to share with them the right information and make sure they're well equipped.
Well, and one last thing before we really jump into it is a good friend of mine, a big speaker, Tom Hegna, if you run across Tom. Mm-hmm. He says, when he's talking about Social Security, he says something very true. He says people spend more time planning their vacation than their Social Security claiming strategy, which I get it. Vacation's a lot more fun. Right? Yeah. Anything duller. I've written a book about it and taught it over 200 times. I can't think of anything that sounds duller at the surface than a Social Security claiming strategy. But that time you spend on that can be hundreds of thousands of dollars of difference, and the difference between you being okay in retirement and not.
Yes. That's why we hope there's a lot of people jumping on here today, or if they can't get on or they have people that need this information, we do record it and we put it up in the group. So it's going to be very valuable.
I know Bo said he had a lot of information, so I think we should get started by introducing Purse Strings and get at it.
Sure, let's do that. So welcome everyone today. Glad that you're joining us. Again, we thank Kim for her opportunity that she's providing us and the ladies here today to have Purse Strings provide a lot of different financial providers. The purpose of Purse Strings is because we want women to be empowered with good information and resources at their fingertips, free no charge. We're at pursestrings.co. We also have our own Facebook Live event at noon Central in our Facebook group, which you'll see down in the little stream down there. And what we want to do is not only provide you the right resources and tools, but also allow you to select from a whole cadre of Purse Strings approved professionals who we have looked for, top of the tier professionals who've been vetted and trained by Purse Strings to really serve a female market. And Bo certainly is one of those professionals. He's on our website as a Purse Strings approved professional. He's expert in Social Security, so we've asked him to come on here today. I know it's an important topic. So Maggie, why don't you go ahead and introduce Bo?
Yeah, so Bo has helped over 3,000 clients not just improve their relationship with money, but also live their unique definition of a fulfilled life with purpose. He has built Rich Life Advisors, where he helps clients across the United States approach retirement with a strategy to save money or save more money, pay less in taxes, properly address the components of creating a successful retirement, as well as protect the people and the things they care about most. When Bo's not working, he's doing all things podcast and radio for his podcast, The Retirement Rescue. And Bo also has a 2-year-old daughter and a new dog, Archie, who like to keep him busy. So Bo, before I hand it over to you, I do want to have everyone else post any questions they may have, and we'll try to get those answered throughout. No question is a dumb question, because I'm sure somebody else has it as well. So Bo, let me hand it over to you.
Very good. So do I need to switch here? Are we seeing my screen now, Maggie? The presentation?
Yep, now everyone should be seeing it.
Okay, perfect. So, Guy, I'm excited to be here and talk about Social Security. It's something I've become very passionate about, just the education and getting good information out there, because every month, really every week, I'm sitting down with households and we're finding 50, 60,000. We had one recently over $200,000 of additional benefit just by knowing the rules and how to use them. And one of the things we kind of talked about as we were getting warmed up before this presentation started, one of the groups I've seen really affected is women by decisions made when they're left in a lot of cases as the solo ager. And, things happen, divorces, or we're single, or we're a survivor, or our spouse passes away. So what I want to do is talk through some things that my kind of promise, so to speak, is that if you hang through this, you're going to have a master's level education in Social Security, and you're going to know more than 96% of your peers out there. So if that sounds good, I'm going to jump right into it. And I want to start with why I even started doing this. I was meeting a friend for lunch. This was probably about 10 years ago. And he was he was 66 years old, and he was running a business, had no intention of stopping his job or working. And he said, Bo, I really messed up. I shortchanged my spouse. And I said, I don't know if I want to hear this story, Jerry. I don't know where you're going with this. But what he was talking about was when he was 66, he had already called Social Security Administration and said, I understand when I reach full retirement age that I can have unlimited earnings. There's no longer earnings caps on how much money I can earn. So should I go ahead and take my benefit? And at 66, he took his benefit and continued to work. And where he was telling, this conversation was a couple years after him turning 66. What he didn't think through, though, was he didn't need this money. Remember, he was just putting it in the bank. Is with his situation, remember we said every situation is completely unique. His wife and his health situation, his wife is most likely, they're still both alive, but she'll most likely outlive him a good 10 to 15 years. And by him taking Social Security at full retirement age versus 70, which in their situation, they could afford to. The situation, again, he was working, earning an income till then. It's going to cost his wife $1,300 a month of benefits she would receive when he passed away. So think about that. $1,300 a month times 12 months times 10 to 15 years. That's over $200,000 of additional benefits she would have one day. And he didn't make this decision because he didn't care. He very much wanted to do what was in her best interest. But he made that decision without thinking with the whole context of the scenario about both lives. And on the way home that night, I realized if a guy that I looked up to as a smart businessman got this wrong, a lot of people in this country are getting this wrong. And that's when I kind of immersed. And since then, I've taught this kind of educational class over 200 times. I wrote a book about it. And what I find is that by just having a basic level of knowing the rules for what applies to you, we're going to cover a lot of things today, but what's important is what applies to you. You know, if you're a survivor or if you're a divorced spouse, what specifically applies to you. And that gives us the things we need to make sure we proactively know the rules about, what we need to dig into and know. Then we can model and compare and say, okay, what's the best options and best decisions for me? Before I move on from the book, I do have copies for everybody that's attending. So this book will go through all the different scenarios we talk about today. So that's just a gift that I told Barb that I'd love to do for this group. So let's jump into it. The big question, whether somebody calls through a radio show, we get questions emailed in about a podcast, somebody comes into our office, comes into a workshop even, what I get is some variation of a question of what if there's a better way? And that results from, what if there's a better way to do retirement? What if there's a better way to do Social Security than what I currently know? Or maybe than what my brother-in-law, somebody at work, or somebody else told me. And that's my goal today, is that we go through this content and you leave here saying, you know what? I know some things today that I didn't know coming in, and I know what specifically to me will help me find the best way possible. We do that, I consider this a big win. What % of retirees live solely on Social Security? Now, that's in this country, and for context, the average benefit's about $1,500 a month. Not a lot to live on for most situations. 38%, so almost 40% of people in this country are living just on their Social Security benefit in retirement. And where that's an issue is that when Social Security was rolled out in 1935, it was truly meant to supplement your savings and prevent old age, you know, not being below poverty in old age. And what's happened is we've been saving less and we're living longer, and we become more and more dependent on this benefit. So we want to make sure that we get the most we possibly can out of this, because we're probably going to need it in most cases. One of the pieces of research that's really been impactful in the last few years is it was a study done. And can you guess? Let me ask a question and see if you can guess the answer to this. So I've said I've done this presentation over 200 times now. When I ask a group, and a lot of times it's live, when I ask a group, how many of you here in attendance would like to get every bit of your Social Security benefit that you're entitled to? Any guesses on what % of the room tells me that's what they want? Anybody? Hands down, across the board, it's 100%. But when we look at the research, do you know what percentage of people actually claim the optimized strategy, or the strategy where they get the most benefit possible? So 100% want it, 4%. 4% are claiming the strategy that gets them the maximized benefit. And it really comes down to knowing the rules. I'm going to flip through some of these. So what I want to talk about basics for everybody, your Social Security benefit, what you need to know as a married couple, options for divorced individuals, what happens if you're a survivor and the widow benefit, taxes and Social Security, and how do we coordinate our Social Security decision with all the other retirement decisions we have to make. One of the questions we have come up often is solvency. Is Social Security going to be there for me? And the good news is, for most people in this group, based on the group itself, when I talk to economists yearly, I talk to people that are making up legislation to address this. There's a general consensus that if you're a line above 50 years old, right, which is good for our group here today, is we should be able to model, which means run different scenarios and plan our retirement based on Social Security as we know it and the rules we know today. So that's the good news. The bad news is, for our kids, guess what? I'm going to have a little different message that says we need to be doing some extra work saving for your pensions and some other things, because Social Security will not always be what it is today. How do they do that? How in the world does government keep this benefit viable? What you see is government kicking the can down the road. That's what they tend to do really well, right? So many of you remember that full retirement benefit age for Social Security was 65 years old. What is it today? From 66 to 67, right? And it's done in 2-month increments. So what does that do? So if your full retirement age goes from 65 to 66 or 66 to 66 in 2 months, That's not going to dramatically change your planning, but that extra 2 months pushback is going to get billions of dollars back into the Social Security system and further kick the can down the road. Another thing that keeps it viable is the earnings cap. Every year you'll see the earnings cap raised. This year it's $142,800. And what that means is up to the first $142,800 you make pays into Social Security. So what happens when that cap's raised a little bit every year? Billions of dollars goes back into the system. So that's what I expect to see, and that's what we expect to see as a consensus from the people that make these rules and the economists that are looking at how this is done, is small incremental changes kicking the can down the road that shouldn't have a significant impact on an individual in this demographic that we talked about, but it won't sustain for our kids and their kids, right? It's going to be a different vehicle. Because remember, when this benefit came out, people, a benefit that started at age 65, people weren't living past 60. So it's actually time for it to be adjusted some for it to be viable. But again, the good news is we can plan based on the rules as we know them. What you need to know for this year, if you were receiving a benefit, you did see a 1.3% cost of living adjustment or a raise to your benefit. Now, why would that be important? Why would it be important to have a cost of living adjustment in a retirement benefit? What's one thing you think that helps us deal with in retirement? It's kind of a dirty word in retirement. It's inflation, right? So having a cost of living adjusted source of income, that's very important when we go to model. How do we pull money out? How do we navigate this? Which pieces do we grow? Which buckets do we take money out of first? Is knowing that cost of living adjustment. The maximum taxable Social Security earnings are $142,800, up from $137,700, meaning the max, again, we talked about that, the cap of what you earn up to $142,800 now pays into the system. And the thresholds for the earnings test have changed, meaning how much can you earn if you pull Social Security before your full retirement age, before they start withholding some benefit. And we'll talk more about that too. So I think this is a good place to just, I know I've been going fast. Are there any questions at this point? Barb, did you have anything you wanted to add?
I just want to jump in here. We do have a couple questions, but I don't know if we'll get to them yet.
Okay.
So the first one is just getting the question out there early. If married at retirement age, is it better to have one partner take Social Security as soon as they can, or have the other wait till they are older? Or
I like that question. Okay, let's do this. So we're going to get to spousal benefits and dealing with that, and let's do the specific questions if we can kind of hold those at the end. Now that's a very good question though. I want to come back to that, Maggie, if possible, but I want to get through the basics of the spousal if we can do that.
Sounds great. We'll go on then, and we'll save some of these questions.
Very good. So the next thing I want to tackle is how is on your statement, and I think most of you have probably seen a Social Security statement at some point, there's going to be a number. There's actually three numbers, but the middle number is what's called your PIA, or your primary insurance amount. And that is the dollar amount of your benefit for Social Security at your full retirement age. Now, I get a lot of theories about this, but how is that number calculated? How do we determine that dollar amount that you receive at full retirement age? I'll hear best 10 years, last 10 years. I get a lot of combinations. And the answer is, it is up to your highest 35 years of earnings record, okay, of earnings history. So what that means, the 10 years comes into play a lot, because you do need at least 10 years, or what they call 40 quarters of earnings history to have a Social Security benefit, but it's up to your top 35 years that makes up that number. So what does that mean? If I work for 25 years, I certainly qualify for a benefit because I got the required 10 years. What do you think happens in the formula to make up that number? So if I work for 25, the remaining 10 years in the formula they're going to plug in zeros. Okay, so you get a zero. You work one extra year, guess what? You're going to plug in one of those zeros. You work one extra year, you're going to plug in another zero, and that's how it can adjust or increase your Social Security benefit amount. Now let's go the other way. What if you work for 40 years? Remember, we said it's just 35 that count. What are we going to do? It's going to be the top 35 out of the 40. So even if you work beyond 35 years, if you're still kind of on the end of your career and kind of in the higher income earning phase of your life, we could still be replacing earlier credits and getting increases in our Social Security benefit. So just a lot of misconceptions, and wanted to briefly touch on how that's calculated. So we talked about your benefit incrementally going from 66 to 67 for most people on this call. So if you look here and you find your birth year on the left-hand column, you'll see this is going to be what you're going to see in your statement is your full retirement age, or the age you're entitled to that primary insurance amount. So everybody can find their spot. And that number is important because that primary insurance amount at full retirement age is how everything else is calculated, whether you file early, late, a spousal benefit, a survivor benefit, everything is calculated off of that number. So that's why you pay so much attention to your primary insurance amount at full retirement age. A couple things we want to know, and this is your benefit, your specific benefit. So if you look on the left-hand column there at retirement age, you see we can take our Social Security benefit as early as age 62. But what do we notice in the right-hand column if we choose to do that? Right. We're going to take a reduction. Okay? So if we can file early, but we're going to take a reduction. So we're going to have a starting point of our Social Security at 75% or a 25% reduction. So we want to know that when we're making those decisions. Plus, remember, until full retirement age, we're limited on how much money we can earn. It's just a little over $18,000 before they start withholding some of your benefit. And we'll talk more about that in a second. The second thing I want to pay attention to on this slide is what happens after full retirement age. And this example is somebody at 66. What do you notice on the right-hand column? You see the 100% at full retirement age. There's 8% guaranteed increases every year you delay past that. Remember my story of my friend Jerry, who told me he shafted his spouse. This is where it played in. He pulled at 66 because he could get 100% of his benefit. But in reality, because he didn't need it, he gave up 32% of additional guaranteed money that his wife would have had one day, will have one day when she survives him. So that's important. To delayed retirement credits. That's the key word there, or the vocabulary of when I delay, I get an 8% guaranteed increase for every year I delay. Now remember, I said there's over 500 possible strategies. Technically, every month you delay, you're getting 0.75% increase in your benefit. So it doesn't have to land exactly on the year. You're getting increases by delaying all the way around. Deciding now or later, reasons that we run across that we find people go ahead and take their benefit early, and 75% of people still take their benefit before full retirement age. One, I call this the ulcer factor. I think some of us here can probably relate to this. You find your job unbearable. I've been sitting across the table of people that say they're coming home every day from work crying because of the admin, the co-workers, whatever's going on. But you know, if it's physically killing you to keep working, maybe we need to pivot and find another way to solve this equation here. You're in a position to where you can sacrifice some of the increased income, or you're worried. We talked about the viability of Social Security, or you're not healthy. Another one I saw come into play this year, pension buyouts, layoffs. If we need the money, that's the biggest reason we have for claiming the benefit early. Reasons people delay is they want to maximize their benefit or their income for the rest of their life. They want to increase the benefit for the surviving spouse, and they're still working and healthy. So just ways we think through that. And especially with that viable, that Social Security won't be here. That's one where I like to go look for data and make decisions based on that rather than emotion. So one of the things we got to talk about with Social Security, if we were to do a little bit of a mind shift, I like to think of it as longevity insurance, because a benefit that'll last the rest of your life, it's going to have a bigger impact, or it's going to be even more important the longer you live. And when I'm sitting talking to a group 10 years ago, I'd ask who in here has family or people they care about in their 90s. It would be 3 or 4 people in a room of 20 to 30 people. Now, when I ask that question, it's 3/4 of the room. People are living longer. And I think one of the issues we're running into with retirement planning is we're underestimating how long we're living, and we're running out of money. And I put this stat up here because it's fascinating to some people, is that if you look at a male, age 65 has a 50% chance of living to 85, 25% chance of 92. Female today, age 65, a 25% chance of living to 94. But look at this one. And I still make a joke about it. I'm not sure why the couples last longer. I'm not sure what's going on there. Maybe they're tougher or something. But couples age 65 today, you got a 25% chance of one of you living to age 97. Now, if we're in our early 60s or mid 60s or even late, early 70s, that's a long time to fund. And we just want to know the reality of people are living longer, and maybe we need to make decisions that protect us from being longer. And Social Security, the strategy we claim there, has a lot to do with that. Real quick, the impact of longevity. If somebody came to me, and I had a guy come to me, and this was about a month ago. He said, I have the same health condition as my dad and my 3 brothers. No male in my family has lived past 74 years old. I'm confident that 75 is a good target age. So based on that information, should this guy start taking his benefit as early as possible, or delay his credits and max it out at 70? What you see here, if he were to die at 70 by 75, if he started as early as possible, he's going to get $37,000 more back. And this is a $1,000 a month benefit for simple math to show the concept. So in this case, short life expectancy, yeah, it makes sense. And he had reasons to think that. More average, living to 85, live 10 more years. If we take it as early as possible versus maxing it out or delaying it until 70, it's almost $64,000 better for us to delay in that case. So if it's more of an average situation we're planning for, the delaying will benefit. And remember, we can do anything in between. This is to show both ends to show the concept. But here's that 25% chance that's in the 90s. If we live another decade, it's over $186,000 more benefit that's received by delaying and maximizing those retirement credits. So it's almost an exponential benefit of protecting us the longer we live. Spousal benefits. Okay, let me talk about this, and I want to take a break again for just checking in. So I get a lot of questions about spousal benefits, and this is going to sound funny, but some confusion comes up between spousal and survival benefits. So a spousal benefits, both spouses are alive. Okay, I know that sounds funny, but just hang with me there. Both spouses are alive. You have to have been married 1 year. The primary worker must have filed, and what we describe as the primary worker, that is a higher income earner in the household. So the spouse had to be married 1 year. Primary worker must have filed. Generally, the spouse applying for the spousal benefit, their own earnings record or their own benefit or their primary insurance amount must be less than 50% of the higher income earner. Okay. So if that's the case, the spousal benefit is entitled to up to 50% of the primary worker or the higher earning spouse. So an example would be John's primary insurance amount's $2,000. James was $800 on her own earnings record. What would her spousal benefit be? Actually, what it would be, she would get her own $800 plus $200 to net her up to half of the spousal benefit. So unless you were born before January 2nd, 1954, and if you were, make a note, that's a separate conversation, because I want to keep that separate because it applies to a lot fewer people. This is how it works. You have to have a benefit that's less than half of the spouses, and the spouse has to have filed for their benefit to trigger you being able to get the spousal benefit. Okay. Any questions on that, make a note. Now, one of the things I want to show here, you remember the middle column was your own benefit. The third column there is how a spousal benefit works. We can take a spousal benefit early. So Jane, in that last example, could take her spousal benefit at 62, but she's going to have a 70% or a 30% reduction in the half of the benefit. So if she was entitled to the 1,000 of John's benefit because he files at 62, she would get 700 instead of 1,000 because she filed early. It's based on when she files. And then if she makes it to her full retirement age to file for the spousal, you see that's 100%. So that's the 1,000 of the 2,000. What do you notice different happening after full retirement age in that far right column? Okay. There's no increases. There's no delayed retirement credits for a spousal benefit. So there's no real incentive to delaying if a spousal benefit's there, if it makes sense. So a lot of times that sweet spot between 66 and 70 is where I'll find $45,000 to $60,000, $70,000 of benefit. A lot of times people will just delay and not get, and it's left on the table. So if it applies to you, we want to model it and see if it makes sense for us to take that spousal benefit, and if so, when in the timeline. So that's one of those things. Spousal benefit, we check the box, we're married a year, one benefit's probably going to be less than half of the other. We need to look into that. We need to model that, and that will give us information to make the best decision we possibly can. Most common mistakes I see with spousal benefits, we talked about it. The higher wage earner files earlier than they need to, and they shortchange the survivor. Because remember, there's 2 Social Security benefits in a household and a couple. And when one spouse dies, the large benefit stays with the surviving spouse and the lower benefit goes away. So that's why, like we talked about, if we file early, the larger benefit, we might be shortchanging the spouse that outlives us. The seconds both delay past full retirement age and no one claims that spousal benefit, that sweet spot of 66 to 70. And sometimes we find that nice chunk of money there that should be taken. And there's not a lot of good places to find information. You can't get advice from Social Security Administration. I've yet to have somebody, I say in 20 years, I've yet to have somebody tell me Social Security's called them up and said, you know what, if you did this other option, you'd have $70,000 more to your benefit, right? So it's really up to us to know what applies to us, research the rules, model it, have somebody run an optimization analysis, and I'll talk a little bit about what that is, and make sure we have the information to feel good that we're making the best decisions possible. Okay, before I go to survivor's benefits, let me check in and see how everybody's doing.
Alrighty, let me see if there's some questions for this. Let's see here. So we're going to go into if a spouse passes away, correct?
That's next, but that first question you had, this is a good time to answer it now that I went through that section.
Okay. If married at retirement age, is it better to have one partner take Social Security as soon as they can, or just have the other wait till they're older?
Yeah. So this is a good question, because what happens is what I'm going to do in a timeline when we're modeling to see how to make your money last as long and get the most use of your money is sometimes if we need income in the timeline, the first place we would look is the smaller benefit, right? Because if we're going to turn on the smaller benefit to get some income in the situation sooner, I don't want to start the larger benefit unless I have to, because what's going to get the bigger benefit of delaying and getting the 8% increases? The larger benefit. So yes, in a lot of cases, all of this depends on pensions, income, expenses, how long you're going to work. If you're going to work part-time is exactly when you turn it on. But a lot of times we do find a strategy when we're kind of going through the checklist that yes, it makes sense to turn on the smaller benefit earlier and get the benefit of letting the bigger benefit grow. Because remember, 8% on a bigger number is going to give you a bigger number, not just for income while you're alive, but income for that surviving spouse. So great question.
Another question that we have is, do benefits continue to increase after 70?
Good question. So 70, it maxes out. So you make it to 70, we're going to turn them on. So that's maxed out. Not always optimized, but that's as big as it's going to get.
All right. And one more question for you. If someone takes their Social Security benefit at age 65, can they stop taking benefits a year later and still get an 8% increase annually and start taking again at age 70?
Okay, that's a good question. That is something you can do. So age 65 would have to be, so if they took it at 60, so what we'd have to do is you can, once you reach full retirement age, so whatever that is, remember it's usually in a range from 66 to 67 at this point. Once you reach full retirement age, you can suspend your benefit, stop it, and then start getting those delayed retirement credits again. So yeah, good question.
All right. We had one more pop up here, and that says, is there a penalty for taking Social Security and still working, or can you do this even?
Yeah. So if you're still working, there's a couple of lines in the timeline. If you reach full retirement age and you're still working, you can make $1 million. There's no cap on how much you can earn. Okay. But if we were to take our benefit and we're working and we haven't reached that full retirement age, there's a very low cap of about, it's just a little under $19,000 we can earn before Social Security would start withholding $1 of your Social Security benefit for every $2 above that $19,000 cap. So we just want to know that and not be surprised. I did have a guy come into a workshop saying, why didn't I get a Social Security check for 6 months? It was because he started pulling his benefit, but was still earning his full-time salary.
Now, if a situation was like that, would that be counted as you not taking your benefits any longer, and then they would also continue to increase, like the previous question?
Yeah, so what would happen there? So if they withheld benefit, it would be factored back into your benefit once you reach full retirement age. So if they withheld some, say, from 62 to 66, then it will be factored back into your benefit at 66, but it would be also spread out over the rest of your life expectancy. So it's not like you're going to get a lump sum to recoup that.
Awesome. Well, I'll let you get back at it.
Okay, let's keep going. So survivors. So I joked earlier And I've just seen places where we kind of have a little confusion. So remember, a spousal benefit's half. It's entitled to up to half of another worker's benefit. A survivor benefit, one spouse has died, right? So we got one spouse is gone, and we kind of already talked about this. The big thing to know with the survivor benefit is that at the death of the first spouse, one benefit goes away. And which one did we say goes away? Right? The smaller benefit. So in a lot of cases, when we're deciding when to turn things on, what to wait, what to take first, we want to see what makes the most sense from that, knowing that a smaller benefit will go away and the larger one will stay, and the larger one will actually stay for both lives. So the larger benefit stays, the smaller benefit goes away. So what happens when a spouse dies? And this is something that's a little bit of a soapbox for me, because we know this happens now. I can tell you exactly what happens in a situation where you have a spouse, when a spouse dies. And when I go through this, sometimes I'll ask, what is your plan for this? And a lot of times we don't have one. And that's a problem, because what happens if we don't have a plan for something we know is going to happen, we're going to deal with it after it happens, right? And we're probably going to have a lot less options, be a lot more vulnerable in a lot different situations. So let me share this. So this was a couple that came to one of the workshops, Bob and Mary. They had pension income there, the top line, $14,406, $406,000, Social Security of $30,096 and $77.90. Total retirement income is that $58,286 number. Okay. So that's what they had in retirement income. Mary came into my office a couple years later and Bob had passed away. Okay. What happens when Bob passed away? Remember, we said the small benefit, Social Security benefit, goes away. So Mary's goes away. Bob's pension actually went away because it was based on his life only. So overnight, the household income here went from $58,286 to $36,096. Now that was a 38% decrease. Okay. Now, on average, income in a household drops by about a third when a spouse dies. It's just how it works. It's just what happens. So if we know income drops by a third, what happens to taxes, right? Your income drops, you pay less tax, right? Unfortunately, no. This is the double whammy here. Your income drops by a third, your tax actually goes up, because now you go from the most favorable tax bracket to the least favorable with your standard deduction cut in half. So if we know that's going to happen, my question is, do we have a plan for that? Is there an asset earmarked to offset that income gap when a spouse dies? Is there a life insurance policy in place? Or do we have our expenses low enough that Mary's just fine here on $36,000? All of those are plans and ways to attack it. But my thing is, if we're talking about it, we don't have a plan for when this happens, I'll figure it out when it happens is not a good plan. Right? And that's my soapbox is we can do something. We're much more likely to be able to do something about it now than we can when it happens. So what's your plan for that? And I brought this up because, again, I have women aging longer than men. My clientele is a higher percentage of women the longer I do this and the older I get and my client base gets. More than 70% of elderly people with income below poverty are women, and more than half of those were not before their husband's death. Now, some of that was probably unavoidable, but some of that with better decisions may not have been. And that's really why I want to talk through this. And why, I made the joke about spending more time on planning your vacation than we do planning your Social Security, but this is really important stuff, right? And this is some of the stats that say with a little better planning, we could do better. Widow benefit. Let me check in. I know we've got a lot of content, and Barbara, I just want to check in with you to see how we're doing on time, or do I need to?
Wow, this information is so important and so enlightening. And it's a lot to take in, I have to say. There's a lot of numbers here, and
right.
You have some excellent examples, and I'm sure people are going through the charts and picking out where they're at and kind of thinking about their own situation. So, yeah, I really hope that women in the audience will jump in and ask their questions, because having you here at this time is really valuable. Mm-hmm. How often does this change year to year? Like, do I need to check all this information out every year to see if I'm on task or what?
Yeah, the overall information, like when you claim, and that's pretty. What what changes is the caps. The caps will adjust every year. So it's something good to check. If you're doing annual reviews or you're sitting down, if you're doing it on your own, you still should be doing an annual review. You know, what's new, what's changed, what do I need to know specific to my situation, and just check those caps so there's no surprises. That's what we want to do. I do a newsletter that you do that. Anytime there's a new rule, I make sure I send out summaries of new rules going into 2021, 2022, things like that. So.
And are there any calculators or anything that people can use to populate some information and see what the best selection is, or would they just have to probably speak with you as a specialist? Yeah,
there's two ways to attack that. One, if you just Google Social Security calculator, there's some software where you can put in some information. The difference is it'll show you different retirement ages. If you're going to do something like an optimization analysis where we're modeling multiple scenarios, that's probably going to need to be done with your advisor.
Okay.
It's just a little bit different level of software to be able to dig into scenarios and calculations.
Yeah, because I can imagine everybody's, like you say, every situation's unique. So you want to make sure you're maximizing it the best way you can based on any other assets or bills or whatever resources that you have. Okay. Yeah, I think this is great. I think we just, Maggie, unless you have questions, I think we just keep moving on.
We have a couple questions about the tax that relates to Social Security. Do you want me to ask those now?
Let me do the tax part. It's coming up real quick.
All right, sounds good. I'll get back at it.
Okay. So the widow benefit is the same as the survivor benefit. What I wanted to show here is, in this case, what can happen. This is a case study. So a widow benefit is a benefit that you can take as early as age 60. It's one example you can take before age 62. But what happens 95% of the time after the fact, when I find this out, somebody will lose a spouse. They'll call Social Security Administration and they'll say, am I entitled to a widow benefit? I heard something about that, or survivor benefit. And in this case, Jane, whose spouse passed away, had a $2,000 benefit. She files for his survivor benefit at 60. Now, remember, she's young, so it's going to be at a reduced amount of $1,430. So that survivor benefit of $1,430, based on her life expectancy of 85 years old, she would get back $429,000 of Social Security benefit and that survivor benefit. Now, that's what happens 95% of the time, and none the wiser. But by knowing how the rules work, this is what we actually did for this case and this lady. We filed for that widow benefit at her age 60, that $1,430 from 60 to 69. But in this example, you can do this in a survivor. Guess what was happening to her own benefit, which was $1,200 at age 62? Guess what was happening to that from 62 to 70? Her own benefit was getting those delayed retirement credits. So by the time she was 70 years old, her benefit was worth $1,980. So guess what you can do in a survivor benefit? You can switch. This is one example where you can still switch your benefit. So in this case, by just knowing the rules, we're able to increase her benefit by almost $100,000, right at $100,000, by knowing she could switch at 70 to her $1,980 benefit, which was now completely maxed out. So just an example of strategy, and when you know the rules, you can compare. This last example was if she decided to work 2 more years, she could take her benefit and then switch to the maxed out spousal survivor benefit at 66 to 85. A little bit less than the middle, but both of those strategic examples are a lot more money than she would have had doing what most people do when this scenario comes up. Divorced spouse. I got to talk about this because statistically this applies to some of us. So a couple rules. These are check boxes. I was married at least 10 years and I'm not currently married. Now you could have been remarried 5 times, but you're currently single and you're married at least 10 years. And if that's the case, you have the exact same benefits that a spousal benefit would have. So if an ex-spouse you know or think it's possible has a benefit that's more than twice yours, you can apply and get up to half of their benefit, okay, in a divorced spouse situation. So that applies to you or someone you know, and you don't know or think it's possible, it's worth checking. You're going to take a divorce decree to the Social Security office, and sometimes we'll find bigger benefits. Sometimes we'll find $200 or $300. But if you're entitled to it, I would think you would want it. In worst case, you know for sure. How does it impact an ex? An ex would never be notified that you started the benefit. They would never know, and it wouldn't impact their current any of their dependents at that point moving forward. I actually had one guy come into a workshop that had 3 ex-spouses he was married to 10 years, all claiming half of his benefit. I don't know exactly how he made that work, but that guy was getting his money's worth out of that. So here we go. Let's go to wages and tax. This was the question. So to understand tax on Social Security, we got to have one definition that's important is provisional income. So if we make a note of anything to understand tax, provisional income, it's going to be 100% of earnings from most sources of income. It's pretty much everything from wages, pensions, 401k distributions, dividends, municipal bond interest. Is pretty much anything except Roth IRA distributions or life insurance distributions, life insurance loan proceeds. So most sources that people have in their retirement income plus you have to add 50% of your Social Security benefit. So my Social Security benefit's $1,000, and I had $1,000 a month, and I had $2,000 of provisional income. That'd be $24,000 for the year. I would have to take half of my Social Security, which would be $6,000. So my provisional income, adding those together, would be $30,000 for the year. Once we know that number, if you're single and your provisional income falls below $25,000, none of your Social Security benefits taxable, 0%. If you're between $25,000 and $34,000 of provisional benefit, half of your benefit would be subjected to your current income tax rate. Okay, so if your income tax rate is 12%, 22%, 50% of your Social Security benefit would be subjected to that. If it's over $34,000 of provisional income, 85% of that's going to be taxed at your current income tax rate. Now, important thing to know here, 85% sounds like a big number, but what percentage of our retirement accounts are taxed in retirement? 401ks and IRAs? 100%. So we want to pay attention to that too when we start deciding how we draw these benefits out. You've got a little bit, these are low thresholds, I know. They haven't been adjusted like a lot of these other numbers. You got a little bit higher caps for couples, up to $32,000 for the zero tax, 32 to 44 for 50% of your benefit tax, and 44,000 plus 85% is going to be taxable. Okay. And sometimes, especially when we have big pensions in the picture, we just got to plan and model based on having to net out that 85% piece. Okay. We talked about this is something that's come up a couple times. So 2021, if you're under full retirement age and you claim your benefit, you can only make $18,960 a year. And every $2 you earn above that, $1 of your benefit will be held and then be recalculated back into your formula at full retirement age. Okay. The year you reach full retirement age, so say I reach 66 this year, the first day of the month I reach full retirement age. So say my birthday is November 30th. So the first day of November 1st, between January 1st and November 1st, I can earn that $50,520 in the year I reach full retirement age. You've got a little more room that year, and they would withhold $1 of benefit for every $3 you earned above that. And then remember on the bottom there, once you reach full retirement age, the cap's off. You can earn as much as you want to. Okay. Questions? Let's check in. That's kind of the tax piece. So let's check in on tax questions.
Okay, so we had one from earlier that was just asking if Social Security is taxed. Is it taxed at the same rate as you're receiving a paycheck, or is it reduced? So I think we
okay, good. I hope that it's reduced. It'll be taxed at your tax rate, but it'll be a percentage based on your provisional income. Right?
And then the income on Social Security is for the entire benefit, correct?
No. So again, it's depending on where we fell in those thresholds. So you're asking a great question, and we kind of went through those thresholds. It'll be if we're under the 50% threshold, none of it's taxable. So it's going to be 0, 50%, or 85% of it will be taxable at your tax rate. Okay.
And then this question is moving back just a little bit. Is there only beneficiary to Social Security for a spouse, or can you choose someone else if you're not married?
No, it's only for a spouse. It's only for a spouse. I mean, there's some scenarios in the household where a child or a dependent would be entitled to a benefit, but the spousal benefit rules and all that is going to be considered to a spouse.
All right, that sounds great. I'll let you keep going.
Okay. Can I change my mind? So I get this question a lot. So say you claimed your benefit 2 months ago and you heard this presentation and say, wow, I learned something. And I wish I reset this. I wish I would have modeled this and got more data and made a different decision. The answer is yes, you can change your mind one time. And how that works is it has to be within the first year of filing your benefit. So you can change it. You can reset it so that your delayed retirement credits and everything are completely reset. One catch, can you guess what that is? Okay. If I pulled a benefit for 4 months and I want to reset it, I'm going to have to pay back the money I pulled out, and then they'll reset it. I've seen it work a few times. I saw it this year. Somebody was laid off, had to take their benefit for 90 days, got another job. We reset it. But I wouldn't recommend this just as something to try, because most of the time, once people choose their benefit, that's kind of what they're stuck with or what they stick with. But it's possible. This will tie everything together, and then we can wrap up with questions. And I think this is going to kind of pull everything together. So this is a case that came through, and I used this one because it really tied a lot of the pieces for me. Couple came in. He was 64, she was 62. Between the two of them, they had just over $34,000 of Social Security income at 62 and 64. They had about $750,000 in retirement assets. We were factoring a 6% average return and 3% inflation, and they needed $70,000 of inflation-adjusted after-tax income and had life expectancies of 86 and 89. Now, this couple came in and said, hey, this is what we want to do, Bo. We're going to go ahead and take our Social Security, and we're going to supplement with our retirement assets. I said, great. Let's actually, before just making a decision based on this sounds good, let's mathematically model it. So what happened here is the blue line here is their Social Security, right? So this is the starting their Social Security now, 62 and 64. The yellow, there's a little bit of a delay here. The yellow is the 401k. So they're supplementing with their 401k. This red line is their income goal. So there's a problem there. So this is why we model, because to them, it sounded like, hey, we got a good chunk of money. We're going to start our Social Security, get it early, get it while we can, and supplement with the other. But what's the problem? See that big hole in the upper right-hand corner? They've got 10 more years of life expectancy, and they're out of money. They're out of 401k assets. So I said, okay, this is what you want to do, and we're going to have to adjust, or you're going to have to make some really hard decisions on into retirement with about 10 years of life expectancy left. So we ran an optimization analysis, and this is what we talk about when we look at multiple scenarios. And what we found is if they would pick up what they wanted to do, remember, they wanted to start their Social Security at 64 and 62. If they would pick it up on their timeline and move it over 4 years, and he filed at 68 and she filed at 66, we just pushed it back 4 years. It would result in them getting an additional $186,496 of Social Security benefit. It's almost a $200,000 shift by just moving things over 4 years. So then we modeled that and compared it and said, okay, here's our optimized strategy, how this works. So if you look here, the blue is still your Social Security, but what do you immediately notice about that? It's a much higher ratio of the retirement need, the retirement income need, right? We still created a problem. Remember, when we're doing this, we're looking for gaps and holes. Where did we create a problem? Now we created a problem that first 4 years, because I made them shift everything, or I encouraged them to shift everything over 4 years. So I gave them a couple options. I said, you can work 4 more years. They told me to go jump in a lake because they were ready to retire. They didn't like that option. Or we start supplementing or bridging early out of the 401k money. And that's the yellow there. So they bridge that, but by the time their Social Security is turned on and optimized, they're having just to do just a little bit to hit their goal with the remaining retirement assets. And look at what happens. So this is strategy, and this is the importance of our claiming strategy, and this is why it ties it all together for me, is just same puzzle pieces we had to work with, but by comparing different options. A lot of times we're comparing 5 different scenarios, but this is 2. Same puzzle pieces, we put them together in a better way, and this couple didn't run out of money. And it was even better than them not running out of money. Here was the total impact: $186,000 of additional Social Security value. Their portfolio lasted 10 more years. And not only did the portfolio last 10 more years, they paid $35,000 less in taxes. So how in the world could you get 10 more years of income and pay $35,000 less in taxes? Well, remember what we talked about earlier. We got to pay attention to how things are taxed. We were getting rid of that higher tax retirement savings money earlier, and we were growing a lower tax cost of living adjusted Social Security to a bigger part of the retirement income. So by shifting them, they're able to get 10 more years of income and $35,000 less in tax. And that's the trifecta. So that's, to me, that's when the win, when we put it all together and we say, okay, same puzzle pieces, but we look at putting them together different ways. Sometimes it's hundreds of thousands of dollars of difference. And sometimes that money is the difference in us having a comfortable retirement and us being uncomfortable. And I know that's important, that security is something we all find or value anyway. So that's really how I kind of wanted to wrap it up. We talked about coordinating our benefits. And I think that case study just showed, while we make Social Security decision in the context of all the other variables of your life, your income, your expenses, your work, pensions, life insurance, long-term care insurance. And then we start saying, how do I put these pieces together in the most efficient, effective way possible to get the best result for me and my household? And that's what modeling is. So I hope we flew through this. We really did. But I hope, at least in all these scenarios, and I know some of them apply to everybody here, that we answered a question. I know more. I know something that applies to me. I know something maybe I'm going to look into a little further to make sure that I'm doing the best I can here, that I learned something today and I answer that question. Maybe there is a better way. So if we did that, I can consider this a success, and thank Barb for having me on this, because I am very passionate about us positioning to do the best we possibly can, and really people not running out of money and having a successful retirement. So let's stop there.
Wow, that's a lot. It was a lot. And I even was aware of a lot of this, but if somebody's just coming into it, they're not in the financial industry, they don't hear a lot of this information on a daily basis, it's a lot. So this is, first of all, why women need to come to the table and make sure decisions being made that will impact her life. She needs to understand what they are and what those impacts are. So I cannot say that enough. That's the whole purpose of Purse Strings, is to provide this great information. And you're getting a lot of kudos from our audience, as you can see.
That's very great. I appreciate it.
Yeah, because these decisions are very, very critical to the, being financially fearless, to a good, healthy retirement. And that's why I think a lot of women are not having a healthy retirement. So we need to make sure women come to the table, come to Purse Strings. At Purse Strings, we provide you these excellent resources like Bo, to really understand it's a puzzle, like you say. It's a puzzle. Really? And it's a lot to take in. It's a lot to learn. I find it kind of tiring after hearing all this information if you haven't heard it before. And really a lot more questions will pop up. So how do people, what do you think, do they start when they're thinking about retirement, or when they're starting their retirement, I'm going to retire next year, or is it 5 years prior? When do they start thinking about their Social Security options?
And we start modeling and looking at it somewhere between 5 and 10 years is optimal, because that gives us time to position the other pieces to optimize your Social Security.
Got it.
So that's really, and you're right. And I want to say kudos to this group, because what I find is this information is not, you can't call the organization called Social Security Administration and get answers. So it's up to us. So kudos to the people that show up to things like this, because if you don't learn it on your own, you don't read books, you don't go to classes, nobody's going to call us up and help us with this.
Right.
So yeah, kudos to you. And speaking of that, I do have books for everybody, Barb.
So I guess I would say they can just shoot us or send their mailing address to info@pursestrings.co. And we'll collect those, and we will send those to you, Bo, and have them mailed out to them. Yeah, Maggie, any questions pop up?
So far, no more questions, just a lot of kudos.
Good. And again, my goal was that if we took 1, 2, 3 ideas of this is what my homework is to dig into and make sure I'm doing the best here, that was what we wanted to accomplish.
Yeah. If nothing else, for me, it's to start thinking about it, having conversations with your spouse if you're married, or having conversations with your family about, or having conversations with your financial professional. And if you don't have one, go to Purse Strings and find a Purse Strings approved professional like you, Bo, who can help people work through these strategies so that they can really optimize their retirement benefits.
Right. And some of these, they seem little decisions. They can be hundreds of thousands of dollars of additional money you and your family get to use and spend. So it is a big deal.
Yeah, it adds up. That's for sure. Okay, well, gosh, Bo, I can't thank you enough. We may even have to have you back again because this information is so informative and so many women need it.
Right.
So this is awesome. Thank you.
Yeah, we could almost break down each component. Like today, we're going to talk about spousal benefits.
Yeah.
Do a special. Yeah.
Sure. Okay, that's good to know for sure.
Well, thanks for having me, guys. I had a lot of fun. I appreciate you letting me teach what I love to teach because I know that it does help a lot of people.
It certainly does.
So you can always reach Bo at Rich Life Advisor. And Bo, what's the name of your podcast again?
The Retirement Resource.
The Retirement Resource. Perfect. So everyone follow that. It's on all the podcast channels. You can find Bo on his website, or he also has his own page on the Purse Strings website as well, pursestrings.co. You can join our Facebook group at Purse Strings for Financially Fearless Women because all of you guys came today fearless and going to take on that Social Security. So thank you again, Bo, and we'll have a handout for this tomorrow, again with Bo's contact information as well.
And then who do we have tomorrow?
Oh, I should know this.
Oh, I know who it is. It's Who Moved My Teeth?
I think that's right.
That's great.
I think it's tomorrow. Linda Lingo's Friday.
Oh, yeah, you're right.
Mm-hmm.
Yep, Who Moved My Teeth? And yeah, that'll be fun. She's pretty funny.
All about elder care. Yeah, she's going to be fun and funny and informative. So there you go.
Awesome. Well,
Okay.
thank you, Bo, from Rich Life Advisor. We'll talk to everyone soon.
See you guys. Thank you.
Bye.
Bye-bye.